And thank you very much to the Capital Markets Authority for inviting me to be here today. I think I'm going to try to build on the two previous talks that we have already heard and to incorporate into that some of the ideas and some of our lessons from our own work in the field of corporate governance. And I will go quickly, and I will not talk about all of my slides on my presentation, but we can talk about them later if people are interested. I think I will pick up where Dr. Kirshner left off on the role of the regulator, essentially the same idea as what he described as the public ordering of the corporate governance rules. I'll talk a little bit about our assessment program and what we have learned from that program, and then we can go into questions. I think without using the same terminology as Dr. Kirshner did, I think it's very interesting to think about the difference between the company level perspective on corporate governance, what he was calling the private ordering, and the policymaker's perspective or the regulator's perspective. Because most of what is talked about, if you go and read a lot of what is written on corporate governance, it talks a lot about what happens inside of companies and inside of financial institutions. And in fact, we can talk a little bit about the international standards, and some of those questions of international standards have already been raised. But most of the international standards are a blend of this idea of the company perspective and the policymaker's perspective. And in fact, there are relatively few standards in the general corporate governance world, in the OECD principles, let's say, on the policymaker's perspective. Most, in a sense, take the company's perspective. So I am just going to very quickly introduce, in a very, maybe not very systematic and not very academic way, what people talk about, what the literature, both the economic literature, but also let's say, the practitioners of corporate governance think of in terms of benefits of good corporate governance. The idea is going from bottom to small to big. For companies themselves, one of the issues about corporate governance and corporate governance regulation is it's supposed to be good for you. You're taking the medicine because it's good for you, not because the doctor tells you to take the medicine. So you should have better decision making, improved access to finance, higher valuation of your shares, and in general, many good outcomes related to having better corporate governance. And we can talk about what that means. For shareholders, it's more obvious. You should have more protection from abuse and higher value of your shares. What's not talked about so much is the value for regulators and supervisors. In a sense, it's the main line or the first line of defense of supervisors, and it should result in increased financial stability. And there's a famous paper that's now actually about 12 years old, looking at information and data from the first financial crisis, or the Asian financial crisis in the late 1990s, that said that basically that if companies with good corporate governance and countries with good corporate governance framework did better during the financial crisis than companies that did not, and countries that did not. And finally, for the overall market and for the overall economy, you should have higher market capitalization, a more successful capital market, more companies that can compete and grow internationally, and in the end, higher growth. Although those things are very difficult to show in the economic literature. These are some charts that use, the World Bank group produces, which some of you may have heard of, a series of indicators of private sector development and regulation called the Doing Business Project. And one of those indicators is called Protecting Investors, and it's a measure of corporate governance, let's say investor protection in a country. So if you group countries into 5 groups according to the rankings assigned by that indicator, this shows the benefits of being in the higher levels of better corporate governance, let's say, as measured by the indicator relative to other countries. You have much higher market capitalization of GDP, especially in the highest quintile of countries, and you have a much higher number of listed companies in those countries. And just, these issues are very difficult to think through, and just to think of, this is a perspective, that my own personal perspective of how to think about the difference between the public ordering and the private ordering, again. If you, on the bottom axis here in this chart is some measure of the quality of corporate governance in a company, and then the vertical axis measures the valuation of the share price. What this is supposed to show, and I think some of the literature that looks at the valuation and corporate governance supports this idea, is that both perspectives are important. Obviously, if you look at the bottom line, which has a higher slope, a higher rate of change, in general, countries with a poor corporate governance legal framework are going to have excuse me, have a lower average in their companies because those companies are not following rules and regulations that are as high as in the second company with better corporate governance framework. But in those companies, companies that want to implement change and want to do better and want to, on their own, come up with a good, strong corporate governance framework will show a higher rate of valuation change, will show more improvement than in countries with a less strong governance framework. To put it in very concrete terms, a company in Canada, for example, which is a country with a good governance framework, even if you're a star company which has done a lot of things to improve its own corporate governance, the market may not reward you that much. But I believe the evidence shows that in other countries, and especially emerging market countries, companies that try to distinguish themselves and do better will have outsized returns, and you really will be able to see major improvements in outcomes. So just to keep to Dr. Kirshner's schedule, we in the World Bank, first of all, just to introduce this topic of standards and codes, as many of you may know, the World Bank and the IMF, well, stepping back, there are 12 standards and codes that were set some time ago by the Financial Stability Forum, now the Financial Stability Board, that were seen as key to financial stability. And this is the list of the full 12. The standards with the arrows are assessed by the World Bank, including corporate governance. So basically, in each of these standards, there's an international standard setter that comes out with a set of standards on what high quality means, and then there's a standard set, an evaluator or someone who goes and looks through various programs to see how countries are complying with these standards. And in the case of corporate governance, it's the OECD who has set these standards through the OECD principles of corporate governance, and the World Bank is responsible for assessing them. And very briefly, we've done this through a process called the ROSC program, Report on Observance of Standards and Codes. We've done about 85 assessments of about 64 countries, looking at the implementation of the OECD principles in different countries. So it kind of gives us a unique perspective on how the standards, international standards in corporate governance are being implemented in different countries and what the challenges and problems are. I will skip these. I think just to return to the basics again, what the principles of corporate governance talk about many things, but they're really three core ideas. One of them is that there are certain basic shareholder rights that shareholders should have in any system. The second is that disclosure and transparency are important, and it discusses what that means. And then the board of directors. The third area is around the board of directors, and the board of directors is important. And coming back to the first talk, this keynote speech this morning, when it's easy to get, I find, when you hear about all the different initiatives around the world and how people disagree on many areas of corporate governance policy and let's say even financial market policy, it's important to come back to the areas where we all agree. Because when the OECD principles came out, it was certainly in retrospect, from my point of view, almost a miraculous coming together, a consensus on what good corporate governance is. Because combining all the different legal models of governance around the world and the different financial market traditions and the different ideas about board of directors, it's still quite amazing that the world could agree, at least to some extent, to a general extent, on what good corporate governance means. And of course, the biggest single change in these issues, in my opinion, is around the role of the board. If there's one thing to take away from corporate governance good practice discussions, it's that the board is important, the board of directors has certain responsibilities and duties, and that a strong board is important. And in many, many countries, most countries, that was not the case, and is still not the case in a lot of countries today. So just, I won't go through these too much in detail. We could talk about them later if people are interested. I think, again, from the point of view of this audience and thinking about what happens in most emerging markets, the key, it's a bit of a challenge in most countries because many corporate governance rules come through company law, but company law in most countries doesn't really have an effective regulator because the courts don't really work as well as they should for minority shareholders. So in those countries where minority protection works better, it's usually because a securities regulator or similar body plays an important role. And I give 4 examples here in the small bullets of how in different countries securities regulators and stock exchanges play an important role. So for example, in Indonesia, they take provisions out of the company law and mirror them in securities regulation so that the securities regulator can enforce those rules. In Egypt, the securities regulator can function as a special, I use the word court, but it's not really a court, but it's a place where shareholders can come and complain and get redress. In Brazil, if company law is violated, then the securities regulator can actually impose penalties on those issues. And in South Africa, the stock exchange plays a major role as an arbiter and actually can enforce corporate governance regulation. So the role of the securities regulator is very important in enforcing corporate governance rules and shareholder right. And when they do so, it benefits everyone because the quality of corporate governance for the whole market improves. Just very briefly, what we have learned is that disclosure is improving everywhere, and to some extent, it's because of the spread of international standards on accounting. We can disagree on the details of international standards, and everybody does disagree, but most 95% of the things that are in international accounting standards, there isn't very much disagreement on, and so it's been an important development. And last but not least, there is board reforms going on in the board of directors. I would challenge one thing that Dr. Kirshner said, which has to do with the whole question of corporate governance codes and how we should think about them. Because Dr. Kirshner presented them as private ordering, meaning a group of companies and private sector individuals coming together to really set the rules themselves for how companies should perform. But in most countries, or many countries, especially English-speaking countries, but not only, corporate governance codes are kind of a blend of private and public ordering. They might be sponsored by the securities regulator. They might be enforced by the securities regulator in the idea of comply or explain. Or some countries even call a corporate governance code a regulation, a corporate governance code, and so it becomes very confusing to interpret. But I think it's not the same as a business group getting together and saying these are the rules we think everyone should follow, which is what we call a voluntary code on this slide, because it somehow has more weight than that, and it's quite difficult to describe. And our main conclusion from working in many countries is corporate governance codes are much more influential when they are supported by a securities regulator and well anchored in the regulation so that everyone understands what they mean. Because people in many countries don't understand what they mean and how they should be complied with. And I think I will stop there. Thank you very much.
Thank you very much, Mr. Berg. I love the World Bank approach. You're confronted with the different initiatives, with a multitude of regulatory approaches, and you have the bird's view. But nevertheless, you have a very solid fundament. I would say two fundaments. The first is the management perspective, having better access to financial markets. Good corporate governance supports access, and enhanced stability of financial markets. When it comes to corporate governance codes, I know that we have different types of codes, and sometimes when we have mandatory codes, this is regulation via camouflage, I would add. And sometimes comply or explain codes go into that direction as well. And we have, I must say, in Germany, some problems with this comply or explain, but Mr. Jo from the Federal Financial Market Authority will explain this in more detail later on. Now, Mr. Agarwal, you have